Alex.
Thank you. Thank you very much, Gugu. And very good morning to everybody. And, welcome to the second AMC, and more importantly, to our second view from the room. And I think, as Gugu said, Sola and I really like to try and position this morning's 20 minutes or 25 minutes that you're going to spend with us as something slightly more informal and slightly more relaxed. So, kind of take it easy, get your phones out, and let's spend 20 minutes, 25 minutes pretending like we were traders. And, there's an expression that one of our traders uses quite often on our daily trading calls, where he says, there are decades where nothing can happen, and there are weeks where decades can happen. And I don't know how lots of you and our colleagues feel, but certainly at the moment when we wake up on a Monday morning and I finish work on a Friday evening, I can feel that during that week, decades have happened. And so it was very much with that in mind that Sola and I thought it would be a very good idea to go back and have a look at the YouTube video of our session this time last year and try and understand two things. One, I wanted to try and get a sense of how many views we got, and Sola, I was hoping it would be in the millions. It was 181. I thought we'd have multiple likes. There were two, Sola. That was probably you and me. But what we wanted to really try and understand is the major themes and the predictions that took place last year. So let me give you a little sense. The major themes that we spoke about, all of us in this room last year, was the word that I used, dislocation. Last year when we were sitting here, there was a dislocation. Dislocation in fiscal policy. Doge going on in the US. Europe talking about embarking on a massive spending spree. Monetary policy dislocation. The US had just kept rates unchanged at their recent meeting, and Europe were cutting. Australia were cutting. Canada were cutting. Massive dislocation. And so, it was a very interesting time. When we think about the themes that we're facing now in 2026, we're talking about very different things. We're talking about AI. We're talking about tariffs. We're talking about geopolitical uncertainty. We're talking about the competition for rare resources and specifically the rare earths. So a year down the line, it's amazing how things can change. Those were the themes then versus the themes now. Shola's going to take you through the market predictions then and how the market has performed since then.
Okay, thank you. Just to point out, this is last year, so don't cast any votes here. But quickly, I'll just go through four of the indices we talked about last year. One was oil. Most of the audience last year had predicted that, 60% of the audience had predicted that oil will range between 60 to 80. At the end of December 31st, 2025, oil was at 61.51. So I think you guys got it right. Round of applause for yourselves. The next one was gold, the mother of all movements. But the interesting thing about gold last year is everyone actually, or majority actually, forecasted that it will end up higher than 3,200. But I don't think anybody expected it will go even much higher than that. So on that too, round of applause to the audience. And then US Treasuries. 10-year US Treasuries, 42%. This was quite mixed last year. 42% said it will end up higher than 4.5%, but it did close at 4.16. So I think you guys missed it that time. And the last one was also another interesting asset class, Bitcoin. 50% of the audience had predicted that it will end between 60,000 and 100,000. And our expert said 100,000. But it closed at 87,000. So you still got it right. Round of applause for yourselves. So we'll go into this year's predictions, and now you can vote. And I think, Alex, you'll start with the first one.
Right, so to kick off, we're going to kick straight off with gold. And if you've all got your Mentimeters fired up, those are the predictions we're giving you. So let's see. As you vote, we're going to get some live graphs going, and it's going to give us a sense of where we're going to settle down. And straight after that, we'll go into where our expert predicts things to end.
Interesting thing last year that many people didn't realize. Last year, gold set 50 all-time highs. in 1 year, we touched the highest ever price of gold 50 times, driven largely by structural reform. And I think the best thing about the price movement of gold was the fact that this wasn't cyclical, it was more structural reforms. And thanks to the central bankers who are here, you were the biggest part of pushing up that price. And if you recall, I did mention last year to the central bankers that a number of central bank governors had asked the Standard Bank as to how to facilitate the purchase of gold. So another reason why you should always come for AMC.
Right, so it looks like we're going to settle on the majority of the audience in the range, Sola.
Yes, it seems everybody is still expecting a rally on the gold price. 56%. Nice.
Right.
Okay.
Should we go to our expert and let's see what our expert has to say? It's going to be very interesting.
We have a high conviction gold will end above 6,000 by the end of this year. For next year, our base case is 7,000, depending on your view of interest rate cuts, but we think 3 cuts will get you there, and any further cuts should get gold between 8 and 10,000. So, of course, there are many variables that drive gold, but we like to focus on the primary fundamentals and to ignore the noise around central bank buying and speculative flows. And these primary fundamentals include money supply and real interest rates. There have been counter-arguments that real interest rates are no longer correlated with gold prices, but we would argue they are, depending on the regime in which you measure those correlations. So while money supply increased 50% over the last 5 years, this has supercharged gold. And as we now drop real interest rates, the pricing of gold is now starting to reflect its true value. Of course, there are potential downside risks, including the shrinkage of the balance sheet by the Fed, but that certainly isn't our base case.
So our expert also agrees with the crowd. An expectation of gold rising as high as 6,000. Again, my comment last year to the ladies was that, please buy more jewelry. Use Standard Bank as your excuse. We said gold price will go up. Okay.
Right, we're going to move on to US Treasuries as our next market where we're going to predict. And here we've given you currently US Treasuries trading slightly over 4%. We've given you the 3 options there, 375 to 425, below 375, and above 425. Shola, I worked very hard with you on our ranges this year to keep everybody away from sitting on the fence, but it doesn't seem like we've done a good enough job.
Again, just like last year,
I know it's
the views were very, very similar.
All right. It looks like we've settled there. I mean, we've got 42% at below 375, which is very interesting. Right. Let's have a look at what our expert junior has to
I
say.
think the US 10-year will settle somewhere between 375 and 425. I'm calling it 410. I think the 10-year is going to be caught in the tension between monetary policy desires and fiscal realities. While inflation remains above target, it's clearly moderated and is under control. And so it's difficult to see us closing well above 425 unless something goes wrong. We've had 75 basis points of cuts thus far, but I think concerns around the labor market, as well as tremendous political pressure to lower yields, means that the market is pricing in between 2 to 3 cuts. It's questionable on whether that's appropriate or not, but even if it were to play out, I think that will likely impact the front end of the curve. I think the 10-year will likely maintain or widen its term premium, and you'll see a curve steepening. And that's why I'm calling it remaining sort of between its recent range of 375 and 425. But my individual point call is 410.
Thanks, Junior. I mean, that's quite different in terms of where we had the audience. So it's, Junior's got that rate materially higher, which is very interesting. Right, Shola.
The next class. Euro USD. So the story about the Euro USD last year was largely around, it was more around dollar weakness rather than Euro strength. Again, the question this year is, are we going to see a rebound of the dollar, or are we going to see continued weakness of dollar and stronger euro? The ranges here are 1.25, below 1.15, between 1.15 and 1.25. Why do I have to feel this is a safe bet that the audience is making? It seems everybody is forecasting more of the same next year, or this year.
Right, that looks pretty settled. I think let's go to the expert.
This year, I think the euro will end the year between 115 and 125. There are many factors that can cause it to move in either direction. The short dollar trade that we've seen and the trend that we've seen in this for the last few years may be thwarted slightly by the geopolitical risks we're seeing rising in Iran and across the rest of Europe. I think the election risk we see in the midterms in France, as well as in the US, I think could show that in Europe things are moving slightly to the right. And I think the overall geopolitical risk may see a stronger dollar if we see oil move a little bit higher. The countries which will be large importers of oil, which Europe will suffer from that. So in my view, I think we will see the euro between 115 and 125, but I'd prefer it closer to 115 towards year end.
Thank you, Tom.
Thank you.
All right, so that's 3 down and 3 to go. The next 3 are going to be slightly different. So we've applied our minds and come up with some different categories that we thought would be really interesting. And so here we're asking the audience to give us a view on what they think the strongest return in 2026 will come from. Mag 7, the S&P 500, Bitcoin, a basket of critical rare earth minerals and metals, or emerging market sovereign CDS.
Why am I not surprised?
Right, that's maybe one of the first overwhelming ones we've had. Sola.
Yeah.
Let's see how that stacks up relative to our expert.
I think a basket of critical and rare earth metals would be the strongest performer out of these asset classes, just given the AI theme and also the midterms coming up, fiscal spending, etc. Just going through each category and maybe a comment on each. Mag 7 equities, I think, are going to underperform given their spending that they've done on data centers. I think they're going to struggle to get those cash flows back, and growth as a factor, large cap as a factor is not going to do well. I think smaller companies are going to benefit more from AI than large companies this year. Even the S&P 500 ex the Mag 7, although more interesting, it's still not an equal weighted basket, which would have been more interesting to me. So even that has too many large cap names in there, and there's big concentration in those. Bitcoin's pretty interesting, but it's behaving like a tech stock at the moment, and it's basically following sort of the software ETF almost tick for tick. So maybe later in the year that starts performing. That's obviously the most volatile in the group. And then the least volatile might be, or at least at the moment, would be emerging market sovereign CDS. Although I do think this will perform well, I just think those spreads have rallied quite a lot already. So it's hard for them to outperform something that could have quite a lot of upside in terms of these critical and rare earth metals.
Yeah, that's an interesting one, and the audience and our experts completely aligned in that one.
But be wary of the situations where everybody thinks something will happen. I remember a certain US election.
Right, so two more to go. And this is an interesting one, so let me just try and explain what we're looking to achieve here. You've got 5 what we'd consider market truths that have been put up for you to consider. The market truth at the moment we feel is that AI will decrease jobs for knowledge workers. A market truth is that the SpaceX XAI ecosystem is going to have to IPO to generate some cash. So those are all market truths. What we're asking for you is for you to select your contrarian view around which of those market truths do you not feel will take place in 2026. So it's a contrarian view on the market truths. I'm fascinated by this one, I must tell you. So AI decreases jobs for knowledge workers. Very interesting to feel like that may not come about, although it's a massive risk at the moment, and that the war in Ukraine remains unresolved. So we feel that that is a contrarian view. 33% of our audience feel that that'll actually get resolved. Okay? Very interesting. Let's leave it there. I think that's kind of settled.
Yeah,
And
I
let's have
think
a look
so.
at what our expert has to say.
The IMF forecast that Africa's GDP growth will be at 4%, and I think they're hugely underestimating what the number is eventually going to be, both for this year and next. When you were looking at Africa at month, 2 months, 3 months ago, you would have underappreciated how much Africa's cost of funding would have dropped and how much capital the continent has been able to attract. The commodity price story has been much stronger than what we had expected. Furthermore, African countries have done a lot on the structural reform side, and we saw a lot of those flows that followed that story coming through over the past few months. So, if you think about where we were a month ago, you think about where we were 2 months ago, you probably would have thought that the story would be positive, but not as positive as how it's played out. I think the number is going to be closer to 5%.
Excellent.
That's a contrarian view to the contrarian view, Shola.
Yes.
It's like, Mama is really being contrarian. Not even the audience went with that.
I think our policymakers will be quite happy with that.
Last one.
And the last one. The strongest performance in sub-Saharan Africa. I think what we're looking for here is of all these three regions, which region do you think is going to perform the best in 2026? Don't ask me, I am biased. Just some quick information. East Africa is the fastest growing region with a projection of about 5.9%, followed by West Africa, 4 point something, and South and Central is about 2.9. We do see that West Africa is driven largely by hydrocarbons. East Africa is driven by the level of diversification of their different economies, so they're not reliant on one thing. And obviously, the most organized is South and Central. Interesting. East Africa.
Yeah. Don't be upset, Shola.
I'll try not to be. Excellent. So let's hear what our expert says.
We expect the strongest outperformance for 2026 to come from West Africa. The continent finds itself in a unique set of circumstances this year and probably for many years to come, where we have a confluence of a commodity boom fueled by AI and fiat debasement, which has supported our trade balances and has allowed us to build up external reserves. A relative reduction in the perceived African risk premium as global policy has become more uncertain has made us an attractive destination for capital and should continue to reduce funding costs, and a number of strong idiosyncratic drivers across many countries across the continent. The combination of which sets the scene for phenomenal 2026 for Africa. That said, while we are broadly constructive across the whole continent, we expect the strongest outperformance to come from West Africa because we see West African markets, specifically Ghana and Nigeria, as markets which have had the strongest instituted structural reforms, have positive exposure to the commodity complex, and have supportive regulatory framework that allows the seamless assimilation of offshore capital into their markets.
Excellent. I think the best thing to take out of this is that across the whole continent, the projections for 2026 are quite positive. And I think this is a time for us as a continent to take advantage, considering the tough periods we went through a few years ago. So I think it's a win for all of us.
Thank you. So, that was wonderful to spend that time with you. I think, we'll go back and have a look at some of those predictions and see how things pan out. And so without further ado, I suppose from Sola and myself, we should probably finish off with our signatory conclusion, which is, that is the long and the short of it. And we thank you very much for joining us, and we'll hand over to the experts.